Top-down analysis in Forex trading. Top-down analysis is a method of chart analysis where traders start by analyzing the larger, higher time frames, such as monthly and weekly charts, and then work down to smaller time frames, such as daily, 4-hour, or 1-hour charts. Helps traders identify overall market trends, and then refine entries and exits based on more detailed views. Every monthly candle is made up of 4 weekly candles. Every weekly candle is made up of 5 daily candles. This is because the market is closed for 2 days on the weekend. Every daily candle is made up of 6 4-hour candles, and every 4-hour candle is made just of 4 1-hour candles. Let's break down the steps of top-down analysis. Start with the higher time frames. Analyze the monthly and weekly charts first. Here, we look for the primary trend direction and mark key supports and resistance levels. Just remember, support is a level where the price has historically struggled to go lower, while resistance is where it has trouble going higher. Move to intermediate time frames. Next, we shift to the daily or 4-hour chart to get a closer look. This helps us spot trends within the main trend and identify potential corrections or retracements. Analyze the lower time frames. Finally, we look at lower time frames, like the 1-hour or even 15-minute chart, to fine-tune our entries and exits. Here, we're looking for specific price action setups or patterns that confirm our trade idea. So, top-down analysis is a powerful tool in Forex trading that allows us to align our trades with the overall market direction. By starting with higher time frames and working our way down, we gain a comprehensive view of the market structure, identify key levels, and make more precise trading decisions. That's about top-down analysis in Forex trading. Thank you for watching. Stay awesome and keep tuning in. See you in the next video.